We consider the market to be, fairly valued overall. So I'd say as far as when you look at whatever your own personal targeted equity allocation is for your portfolio, I'd still remain market weight the US equity market overall.
Okay, so from a valuation perspective, we're at market weight on equities today.
Exactly.
Okay, so then let's break down the market by capitalization and style. How do valuations look there?
So by capitalization, still like overweighting small cap stocks. They've been outperforming since the end of, well, actually since like November of last year, but that's still where we see the best value by capitalization. In order to do that, you probably need to underweight mid caps and probably keep a market weight on large caps. By style, I would look to overweight growth. That's the most undervalued area. In order to overweight that, you probably need to underweight the core category, even though it's not necessarily trading, at a big premium. And I would still market weight, value stocks, although I keep my focus there really on looking for, those individual value stocks that, are trading at pretty deep discounts to intrinsic valuation. And I think having those value stocks will offset, some of the volatility that I expect to see in the growth category, over the course of this year.
So we did talk a little bit last week about the small cap stock rally. So small caps still look undervalued even after that rally.
Yeah,
okay.
So they're still at a 13% discount to fair value. They've been outperforming, so they've got, very good momentum behind them. Really one of the few areas that are still undervalued in the marketplace today. Thinking about, 2026 and what's ahead, we are looking for the Fed to ease monetary policy. So, looking for at least, 2 more cuts, more likely than not in the second half of this year. Overall, our U.S. economics team is looking for long-term interest rates to decline. The economy's running, much better than expected. And then also just thinking about 2026, and we've seen it, starting to pop up, but I expect to still see a lot more mergers and acquisitions, whether that's, private equity buyouts or strategic acquisitions. I think all of those will help keep, small cap stocks, doing pretty well this year. And of course, I just note for most investors, I still think you're better off in ETFs than, or even mutual funds than individual stocks. You get that diversification inherent, in those portfolios. And then once you have that diversification, then start looking at and picking away on some individual small caps.
All right, well, it's time for everyone's favorite part of the show, and that's your picks of the week, Dave. So this week, you've brought us 4 stocks that are currently trading at attractive discounts and that have some either stock price momentum or are tied to a key theme that should help narrow their discounts over time. So your first pick this week is Clorox. Run through the numbers on it.
Yeah, so Clorox is trading at a 27% discount, more than enough to put it in 4-star territory. Nice healthy dividend yield at 4.2%. We rate the company with a medium uncertainty and a wide economic moat, and that wide economic moat being based on their cost advantages and intangible assets.
Now, Clorox stock is having quite a good year. It's up 19% already. And the company reported earnings last week as well. So give us the highlights from the earnings report and tell us why you like the stock.
Yeah, well, actually, I'd started recommending this one a while ago. And unfortunately, I think I was too early in recommending, this stock. It definitely did trade down for a while, before it bottomed out. But I think this is also a good example of, why I always recommend starting with a partial position, leaving some dry powder so that way you can dollar cost average in, to the downside. In this case, when we look at earnings, seeing some stabilization here. It appears that the worst is behind us. Volumes this past quarter were only down, 1%. But more importantly than that, we're also making sure that the company is holding its market share. It's not losing market share to private label at this point. So it is just a stock that I consider to be pretty undervalued, even when I think we have very modest forecast assumptions. Taking a look at the top line, we're only looking for an average of 1.3% compound annual growth rate over the next 5 years. Looking for operating margins only just to get back towards historical averages. So at this point, looking for 7% average earnings growth, and the stock's only trading at 16 point something times our fiscal 2026 earnings estimate. So still looks pretty attractive even after the pop thus far this year.
All right, your second stock pick this week also reported earnings last week. It's Mondelez International. So give us the key metrics on this one.
So Mondelez is a 5-star rated stock, trades at an 18% discount to fair value, has a 3.3% dividend yield. We rate this company with a low uncertainty and a wide economic moat, that wide economic moat being based on its cost advantage and intangible assets.
Now, Mondelez the stock's also having a pretty good year. It's up about 11%, yet still looks pretty undervalued. So why do you like it?
So generally, I'd say Mondelez has really had the same problems as all the other food manufacturers that we've been talking about for quite a while. Volumes still remain under pressure. At the same point in time, costs have been increasing. They're having a tough time pushing through the price increases. So we're definitely seeing a lot of pressure on margins. But overall, Mondelez has very strong brands. In fact, our analyst has noted that 70% of its snack offerings are either at least holding, if not gaining, market share. And I think what I like about this company is, with the U.S. market trading at, pretty high valuations, a lot of people are asking for, stock picks, that are going to be, more levered to the emerging markets. So in this case, you can get, essentially a domestic company that has a good blend of sales in the emerging markets. I think about 40% of sales here go to EM, whereas most US food companies are only 25 to 30%. And in this case, management has said that they're targeting at least, mid-single digit, long-term growth in the emerging markets, whereas you're only going to get like low single digit growth in the developed markets. Taking a look at our model here, total revenue, 5-year compound annual growth rate, 3.8%. We're looking for some gradual margins, margin improvement over the next couple of years. But again, just getting back towards more historical type averages. So we're looking at, 10% earnings growth from 2026 to 2029 and still only trades at 17 times our 2026 earnings estimate.
Your third pick this week is Constellation Brands. Give us the highlights on this one.
So it's a 4-star rated stock, 25% discount, 2.5% dividend yield. We rate the company with a medium uncertainty, also a wide economic moat based on cost advantages and intangible assets.
Now, Constellation's Brands, here's another stock with some momentum. It's up nearly 20% this year. So why do you think it still has more room to run?
Well, and unfortunately, this is another one where I probably started recommending this, too early. It did still have, further to go to the downside before it bottomed out. But again, another good example of dollar cost averaging into positions, to the downside. In this case, I think we're starting to see some evidence that the decline in alcoholic consumption is over, starting to see consumption stabilizing, at the current levels. Revenue from beer only declined 1% this past quarter. That's much better than the 5% contraction, we've been seeing, for quite a while now. Company also noted some new product launches are helping to offset, those declines. Now, of course, beer, specifically the Corona and Modelo brands are about 90% of sales. So that's why we're following, beer so closely here. Operating margins, now finally starting to hold in there. And then lastly, the company for the past 3 quarters has made, over $800 million worth of share buybacks. That should be very value accretive to shareholders over time, considering how much of a discount that stock is trading at. Taking a look at our earnings estimate for this year at $11.57, stock's only trading at 14 times that multiple. So still looks pretty attractive to us even after that pop.
All right. And then your final pick this week is Palo Alto Networks. What's the quick overview?
So it's a 4-star rated stock, trades at a 29% discount, not appropriate for dividend investors as they don't have a dividend. Now, it is a tech stock, so we rate it with a high uncertainty, but that really doesn't cause me any concern in this case. We do rate the company with a wide economic moat based on its network effect and switching costs.
Now, unlike your other picks this week, Palo Alto doesn't really have that positive market sentiment behind it. So why is this one a stock that you think could see its discount narrow? Is it because of that cybersecurity theme?
Yeah, you know me. I like the cybersecurity industry from an investing point of view. To some degree, I think all of the cyber stocks, this one included, have gotten pulled down with the other software stocks. And when I think about software in general and AI, and then think about, cybersecurity, I don't think that people are going to make homegrown, AI platforms in order to try and do their own cybersecurity software. If anything, I think, the increase in artificial intelligence and the potential that that has for hacking makes, cybersecurity, even more important in the future than it is today. Cybercrime, of course, is a very high severity issue, yet the cost of protecting against it is only a small percent of the cost of incurring it. If you were actually to get hacked, cybersecurity is only a small percent of overall IT budget. So it's not an area where I think you have management, looking to cut costs. Huge switching costs if you're to try and move, from one cybersecurity platform to another. And of course, trying to build your own has a lot of risk to it. So at this point, I think this is one of those areas within software that has a lot of, economic moats that protected this business overall. Taking a quick look at our model, we're looking for 13%, top line growth, compound annual growth rate, and looking for 27% earnings growth. This is, in my mind, still one of the faster growing areas, in technology, yet trading at a very large discount to our long-term intrinsic value.
Between tax refunds expected to be thousands of dollars higher, between tax law changes that are saving companies billions of dollars and boosting profits, we are set to see another year of strong growth for stocks. That's why I dug into the numbers on 63 of the biggest tech stocks, researching growth, profitability, and earnings power to narrow it down to the top 10 stocks to buy right now. Stocks with an average 53% upside return to price targets. Let's get started here with Amphenol Corporation, ticker APH, a global leader in the interconnect solutions, those the cables, the sensors, and the fiber optic products across automotive, aerospace, defense, and industrial. This stock up 100% just in the last year. I'm going to show you how I put this information together and why it is so important next. But here we see revenue growth expected this year for Amphenol Corporation, 31% higher revenue growth, 24% operating margin. So converting 24% of that revenue into operating profitability. Even better here, even better than one of the leading stocks for profitability within its industry is that it's increasing that profitability over the last 5 years, has been able to increase its profitability by almost 5% over the years from the pandemic. For each of the stocks in this list, also going to be looking at the analyst price targets here. And folks, I know analysts are not infallible. Hell, I think half of the analysts I knew when I was working there on Wall Street myself, probably more familiar with swimsuit models than they were with cash flow models. But, looking at these analyst expectations, you can get a little bit more confidence in your own research, confidence to see these average price targets so much higher than the high price target, especially when you see the low price target by analysts on Wall Street that is above the current price target. We don't see that here with APH, but we do see 18% upside to this average price target of $172, 43% upside to the $210 per share. We do see a 7.5% discount downside to the low target there by these 11 ranked analysts. But what's important to understand also here, folks, these are 1-year price targets. Okay, this doesn't account for the longer term competitive advantages and strength in each of these 10 companies within their industry. So much higher upside over several years for these companies. That's why I also want to look at these analyst price targets just to see what kind of a 1-year estimate they have for these stocks. Also within that electronics and instruments industry there, TE Connectivity, ticker TEL, shares here up 50% over the last year. Now this one is also in the electrical connectors and components, so you might consider just one of these stocks among the two. Both of them very strong competitive advantages in that field. Growth, very good names. We see that here in the 26% revenue growth expected for the company this year, 18% operating margin. So both that revenue growth and the operating profitability a little lower compared to APH, but this stock is in a better valuation territory. Okay, so if we go here to the statistics here on Yahoo Finance, we can see some of these valuation measures. Again, I'm going to show you how to put all this together next, but we see 3.7 times on a price to sales basis. That is about half of the price to sales basis or valuation we see there on shares of APH. So even though it is selling for, it is expecting a little bit slower revenue growth, a little slower operating margin, it is about half as expensive there as shares of APH. So it takes a little bit more research, but I think I would go with the TEL over that as well. Here we see, again, just like we saw with that APH, improving on its operating margin. Okay, so the operating margin change from 2019 to the last 12 months here, up 4% on that operating profitability. We see some of that valuation upside here in the analyst price targets for TEL, 21% upside to the average price target, high target of $306. That's 33% higher from where the stock is now. And here, exactly what I like to see. Even the lowest analyst price target there on Wall Street of 11 analysts covering this stock, 6.5% upside there to the $244 price target. Again, folks, this does not guarantee you make money on this stock. Those analysts are not infallible. But this does give you more confidence in the stocks that and your own research that even the lowest price target by an analyst there on Wall Street sees real value in this stock. Now, we're just getting started with those stocks to buy, but I want to walk you through how I put this together, how easy it can be to start your own research and to find these top stocks. I started here by downloading the market cap, so the market value of all the shares in the market, the total market value of that company there, the industry within the tech sector, all these stocks in the tech sector, but very important to break it down into industry. I'm going to talk about that in a little bit. Then the margins from the Bloomberg terminal. I got all this from Bloomberg. You can get it from Yahoo Finance. You can get it from pretty much any other any site, but I got these from the Bloomberg terminal. Got the gross margin, which is the percentage of sales left over after paying suppliers, after paying production costs. Very important signal of the strength, the power a company has over its buyers as well as suppliers, some competitive advantages in that. Then I got the operating margin. Operating margin is just the percentage of sales left over after first paying those gross product costs. So the production, the buyer, the suppliers, as well as some of the operating expenses. So you've got your R&D, your marketing, your staffing, some of those other operating expenses, leaves you with the operating profitability. 58% here for NVIDIA. That means NVIDIA is able to convert every dollar in sales into 58 cents. Okay, so 58% of that revenue is being converted into operating profits. Very important. Then, of course, I got the revenue growth. Okay, it doesn't make much sense to be converting a lot of that revenue into profits if you have no revenue growth. So look for revenue growth there off Yahoo Finance, found 56.9% there for NVIDIA. Also went back to the Bloomberg data there and got the gross and operating margins over the past. Okay, so I wanted to see where that company is heading in terms of profitability. Very important. Wanted to see, okay, for pre-pandemic, how well that company is adjusting to post-pandemic business models and able to grow its operating profitability. Here we see with NVIDIA grown its operating profitability. Not only is it probably the strongest, most profitable company in its semiconductors and equipment space, it is also getting more profitable, 26% more profitable from 2019 to the current last 12 months operating margin. Once I had all that information, I broke these down into their industries, very important, and then found the top three within each of those fundamentals. Okay, so found the top three revenue growth, found the top three operating profitability, the top three for change within that operating profitability. Okay, so who's getting more profitable, who's getting less profitable, and very important that you break these down into industry, because the best stocks or the best growth, the best profitability in one industry might not be the same as the best growth in another. For example, here we see with the electronic equipment and instruments, we've got average revenue growth about 20% there. So there you would have to have 26 to 51% to be really in the top tier, really have those competitive advantages, really be growing revenue faster than the others in that industry. We go down here to something like the IT services industry, much slower, other than Snowflake there, just 11% average revenue growth. So there you could have, maybe high or low double digits, maybe 20% revenue growth, still have very good revenue growth there in the IT services. Okay, very important to compare your stocks within the industry against comparable companies. That's going to show you not only which companies are converting that higher revenue into operating profits, but it's also going to be your best clue into what companies have those competitive advantages. Okay, if all these companies in the electronic equipment and instruments industry, if they're all growing at about 20% a year, why is Amphenol, why is TE Connectivity able to grow at 31, 26%? Why are they able to grow revenue so much faster? And it's probably because they have some kind of competitive advantage over these other companies in their branding, in their marketing, in just their power over suppliers, power over buyers. They're able to charge whatever they want and get those higher operating margins, as well as take more market share and get that higher revenue growth. Last note here before we get back to this list, notice I did not just take the highest earnings power, the highest profitability stocks. I used this as a starting point for the research before looking at the valuation, some of these other competitive advantages. But this is where you need to start. These numbers that can show you which companies have those real advantages over its competitors. You start here with the companies that have the higher revenue growth, that have the higher profitability, that are also increasing that profitability. Then you go to the evaluation measures there on Yahoo Finance or there on any brokerage platform. You compare, you find which stocks are growing fastest, converting more of that into profitability, into profits, as well as which ones are priced at an attractive level. First stock here into the hardware storage and peripherals industry, an industry that has just boomed over the last year on that memory shortage in the AI data center build out. Up here, Western Digital Corporation, ticker WDC, shares up 403% over the last year. You see that booming demand here in the revenue growth expected this year, almost 79% revenue growth, 25% operating profitability. And again, if you look into this, folks, you see why this has such a strong operating profitability, because that memory shortage within the AI data center build out, they are able to pretty much charge whatever they want. Memory prices for memory components has gone up like 80 and 90% over the last year, just because there's such a demand for in this AI data center build out. Western Digital able to raise its prices and still get that 79% sales growth. So it is converting a lot of that revenue into operating profitability. What's more, it has grown that profitability by 25% over the last 5 years. But then after that 400% upside in the stock over the last year, we do see some disagreement from the analyst community here. 16% upside left to the average price target of $307 per share. 58% upside still to the high target. But we do have a couple of bearish analysts here. One analyst with a $170 low price target. That's about 36% downside. So I would like to see maybe these shares come down a little bit of better dip buying opportunity. But you cannot deny the strength in that memory chip cycle, as well as just the strength within that the WDC has over its competitors. All you out there in the nation know, one of my favorite tech stocks here, Super Microcomputer, ticker SMCI, really the pure play AI server maker, and now expanding into full data center concierge services, which could boost those margins, that profitability. Really the sticking point for shares of SMCI over the last year, down 21% on this 1 year chart. But you can see here up and down, from $30 all the way up to $60, up and down time and again for this stock. Extremely volatile. I'm going to show you how to reduce that volatility, how to lower your risk next. But this company controls 22% of that high performance server market, really competing on price, taking that market share in a high growth market. And you see some of that here in this 87% revenue growth expected, just reported last week, 123% revenue growth in the most recent quarter, 87% expected for the full year. But here, the operating profitability, just 4.4%. Basically what is happening here, folks, is this company is lowering its prices on its those high performance servers. It is increasing its increasing what it spends on R&D, marketing, other costs to take that market share, really trying to take up to a third of that market from its competitors. And then that's when you're going to see this company raise prices. It's going to see them raise that profitability. And I think it's really going to take the earnings power of this stock higher. Because of that up and down roller coaster in the stock here, analysts are all over the map on price targets. We do have a 14% upside to the $38 average price target, $63 high target to 85% upside here. But we do have that one low target by Goldman Sachs, $26 per share. That would be about 23% downside from where the stock is trading at now. Now, I'm not sure I put a whole lot of faith into that Goldman Sachs target. Rumor is on Wall Street that because SMCI used to use Goldman Sachs for its funding needs, for some of those shorter term debt issued needs, it actually went to a different bank. It went to, it was JP Morgan or Morgan Stanley for its most recent debt issue to for those funding needs. Goldman Sachs got a little mad and put out that low price target. So maybe a little tit for tat, a little bit of vengeance there for Goldman Sachs. That's why I don't put a whole lot of faith in that low price target. Because if you look at the valuation on this stock, it is just too cheap to buy. Okay, how do you get a stock growing its revenue at 87% a year and trading at a price to sales of just 0.77 times? Okay, that means investors are paying just 77 cents for every dollar in sales reported by SMCI, by Supermicrocomputer. And yes, I understand it is not converting a lot of those sales into profits, just 4 or 5% operating profitability there. But when it does increase those margins, when it decides it has enough of that high performance AI server space, it starts raising its prices, as well as this new entry into the data center concierge service, which is much higher margin. You're going to see investors come back. You're going to see it increase that profitability. You're going to see investors come back, push this up higher to even that 1.43 times price to sales it traded at last year. That would be almost twice. This stock could be almost twice this price and would still be a good deal.